Good evening and namaskar, everyone. A very warm welcome to our respected chairman, sir, of the committee, CA Dr. Debashish Mitra, sir, past president to ICI and chairman of Expert Advisory Committee, our esteemed speaker, CA Vinod Kothari, sir, and all the dear participants. It gives me an immense pleasure to welcome you all on this webinar on issues related to companies, small companies. Dear viewers, this is a topic of critical importance as small company forms the backbone of our economy, even driving the innovations and generating employment and contributing significantly to the economic growth. So today we have gathered to discuss and address the challenges faced by these small companies in their journey towards sustainability and success. The insights shared during this session aim to shed light on the key areas of improvements, innovative strategies, and collaborative solutions to support their growth. To set the tone for this meaningful discussion, I'm honored to introduce our esteemed chairman, sir, whose vast experience and visionary leadership have been instrumental in shaping the profession. Sir, we are privileged to have you with us to share your insights and valuable perspectives as keynote address on the topic of the day. Over to you, sir, and welcome once again.
Thank you very much, Nisha ji. Vinod Kothari ji from Calcutta. A very good evening to you, all of you, and to all the delegates who are present here. I have been told that we are nearing 900 delegates now. So a very, very good evening and warm welcome on behalf of Corporate Law and Corporate Governance Committee of the Institute. Let me tell you, this topic we purposefully chose when we were discussing the topic because, when we were discussing this topic, an issue came before me. There was this company, X and Company Limited. And when we were doing the audit, we found that cash flow statement was not being prepared for X and Company Limited. So I asked the question from the finance head that why haven't you prepared the cash flow statement of X and Company Limited? So the finance head told me that, sir, you don't know the paid up capital of the company is less than 4 crores, which is the limit for small companies. And the turnover is less than 40 crores, which is also below the limit of the turnover. And consequently, sir, we are not required to prepare a cash flow statement. Section 2, subsection 40 of the Companies Act lays down the definition of financial statements. And they said that, sir, we are exempted from preparing cash flow statement. I said that, but you are talking to me about section 2, subsection 40. What does section 2, subsection 85 read with the company's definition rules say about small companies? So he said that, sir, even if you require to read the rules, we are below the turnover level, we are below the paid up capital level, 4 crores and 40 crores. So we are not required to. I said, can we have a look at the section 2, subsection 85? He opened the section. And please note the heading of the section stated that a small company cannot be a public limited company. And Vinodji will correct me if I'm wrong. At that point of time, we see, is a small company cannot be a public limited company. And this was the company which was X and Company Limited. It was a public limited company. Just they were only looking at the turnover criteria. They were only looking about the paid up capital criteria and stating that it is a small company. So those of us who are listening to me, please note that a public company cannot be treated as a small company. Even a Section 8 company cannot be treated as a small company. A holding and a subsidiary cannot be treated as a small company. All these, areas will be discussed in detail by Vinodji. You see, many of you have heard him speaking, and he is an expert on the subject. And on audit, many of us, we do this internal financial control, IFC reporting. Now, this IFC reporting is also small companies are also exempted from this IFC reporting. So, the small companies, this whole concept, which was introduced in the budget of 2021, the whole concept was brought in for ease of doing business. And I believe that there will be further exemptions given as time progresses on this aspect or on this very important area of small companies. Here, let me tell you that, at the fag end of my term in 2023, I had the pleasure of writing a preface to a book or to a publication of Corporate Law and Corporate Governance Committee on small companies. So, those of us who would like to know more about small companies, you may refer to this publication of the corporate laws and the corporate governance committee. I would think that you would find it very useful. With these words, I hope that you have a very enlightening and interesting and enjoyable session with Vinod Kothari. Those of us who would travel, who can travel to Calcutta on the 18th of January, we are celebrating 75th meeting of the Corporate Law and Corporate Governance Committee in Calcutta. And we propose to have a corporate law conclave on the 18th of January in Calcutta. So those of us who are listening in Calcutta may kindly block this date. And those of us who are in other parts of the country who would like to travel to Calcutta, please, you're most welcome, because we're trying to have the best of speakers from all over the country to address this corporate law conclave. So with these words, I wish all of you a very, very happy learning and all the very best. Thank you very much.
Thank you, sir. Now, following the keynote address, we are fortunate to have with us CA Vinod Kothari, sir, an eminent speaker with over 30 years of experience in corporate law. His expertise, knowledge, and deep understanding of the sector will provide us with valuable insight into addressing small business challenges. His session promises to be a treasure trove of information and practical solutions. Once again, I extend my warmest welcome to all of you and encourage active participations throughout this webinar. Let us seize this opportunity to learn, share, and collaborate for the betterment of small companies and their ecosystems. So let me invite our speaker to begin the session. Over to you, sir.
Nishaji, thank you very much. And Dr. Mitra, once again, thanks a ton for giving me the opportunity. It's something that I would definitely cherish. And given the number of participants gathered today, it's a huge privilege to be addressing all of you. So participants, while I'm not personally able to see you, but well, you are connected via the link. And therefore, I would be most happy to interact with all of you. Please do share your queries, questions, feedback, comments, whatever might be, to Nishaji. And Nishaji, I'll be most happy to address questions as they come during the meeting. Let's begin straight away. And Dr. Mitra gave a very befitting preface to the entire discussion. He did say that people quite often have flawed view of the meaning of small companies. And the word small company is extremely important. And Nishaji started by saying that small companies are the backbone of the country's economy. We are using the word in two contexts. We're using the word in context of corporate laws. We use the word small company. In the context of industrial policy, we use the word small and medium enterprises, SME. And sometimes we also use the word MSME, which of course includes micro. So the industrial policy classification of SME and the Companies Act classification of small companies is not aligned, not the same. Because when it comes to the Companies Act has chosen its own definition based on paid up capital and turnover, whereas the definition of industrial policy relies on turnover and net worth. Here we're talking about paid up capital and turnover as the basis. Therefore, what is MSME or SME for industrial policy purposes need not be a small company for the purpose of Companies Act. And why is the discussion on small companies so very important? The discussion became extremely important recently. The concept was introduced ever since the Companies Act 2013 came. But as gradually there were increasing regulations on, first of all, public companies, and then regulations were introduced even on private companies, there was some carve out for small companies. And this is exactly where the definition of small company became extremely important. I would be very blunt in saying that people wouldn't have bothered so much about this topic of small company had it not been for the mandatory dematerialization of shares of private companies. As I'm sure all chartered accountants are aware, mandatory demat of private companies was to be completed by September 30th. The timeline for that has passed already. Private companies were also covered. Initially to start with listed companies, then public companies, and later on private companies too. But when the law was extended to private companies, there was a carve out given to small companies. So if the company happens to be a private company, yet a small company, it would not need to go for demat of the shareholding. And I'm sure everyone understands that dematting is not it's quite a hassle. So if the company can enjoy the benefit of not having to dematerialize, that's an important privilege for the company. That apart, of course, Caro report is also not applicable. Dr. Mitra mentioned about internal financial control not being applicable. So there are significant exceptions, significant privileges to small companies, and therefore understanding what exactly is a small company, what exactly qualifies, on what conditions will a company qualify to be a small company, become significant. So we'll first talk about what is a small company, then we'll talk about what are the privileges of small companies, and we'll expand on each of the privileges as to what does it mean to have the privilege of being a small company. Let me get started with bringing to you the meaning of small companies first. And I must just add a prefatory statement that this concept of granting exemptions to small companies, is it something unique to India? Is it something which is kind of a gift from the regulators? I would surely say no. On the contrary, in lots and lots of other countries too, small companies are given almost total liberty from whole lot of regulatory provisions. So much so that in many countries, even the holding of AGMs is not mandated. For companies which qualify to be small companies, there is a lot of relaxation. In fact, compared to other countries, India has actually been very niggardly, very narrow, very reserved in giving liberties to both private companies and small companies. Because as I'm sure many of you would recall that when the 2013 statute came, most of the exemptions for private companies were withdrawn from the law and they were made a matter of notification. Law does not grant the benefits to private companies. Law enabled the government to come up with a notification. And consequently, the government came with some notifications granting some exemptions to small companies, but largely the applicability of the law is now much more stricter on private companies than it was under the 56 Act. Now, a small company is a subset of private companies. Dr. Mitra started with his example, saying that if the company is not a private company, how could it be a small company? Because the very meaning of a private company, the very meaning of a small company, is a company which is a private company. So if the company is not a private company at all, if it's like I was saying, acts limited, which means the company is not a private company, the company cannot qualify to be a small company, no matter what its paid up capital or turnover would be. So it's a subset. Private company has a subset called small companies. Private companies has a subset called one-person companies too. So these are subsets. In a sense, therefore, in order for a small company to qualify as such, it also has to be a private company. Now, what we are going to do, therefore, over this whatever time that Nishaji gives me, and whatever time that you all think you are still having the endurance to listen to me, let me know when you don't have the endurance. In that case, we can wind it up sooner, because it's the talk on small company. I shouldn't be making a very long talk on a small company. The company is small. The talk may also be maybe proportionally small, depending on what's the level of detail or interest that you are wanting to get into. So I look forward to your question, but let me start exposing the subject before we hear your question. So what you're going to do over this, whatever time you think you can sustain, we'll talk about meaning of a small company, and we'll detail out each of the criteria. Then we'll talk about the exclusions from the definition of small companies, meaning companies which wouldn't qualify. Like Dr. Mitra mentioned, a holding subsidiary company will not qualify. A Section 8 company wouldn't qualify. Companies governed by special act. Now, this issue also, there's been a lot of discussion, particularly in context of non-banking finance companies. People have been questioning whether an NBFC is governed by a separate act, namely the RBI Act. And therefore, an NBFC cannot be a small company because it's governed by a separate act. So what is the what is the strength of this argument? So we'll discuss NBFCs versus small companies. And like I mentioned, the definition of small company and the definition of SME are not the same. Therefore, I would do a quick comparison of the definitions as well. And then we'll talk about the various exceptions and relaxations applicable to small companies, starting from cash flow statement that Dr. Mitra was talking about, then the so-called abridged financial statements, annual return, board report, certification of several returns, auditors, importantly, CARO, number of board meetings, demat of securities, very, very important. Relaxation with respect to filing of documents, meaning in case of small companies, you don't necessarily have to run to get a certificate from a practicing professional. The secretary or the director can do it himself. Lesser penalty for non-compliances, lesser filing fees, and also the possibility of doing a fast-track merger. We will also give a comparison of the exemptions applicable to private companies, because eventually if the company is a small company, it's also a private company. And therefore, as a private company, it's entitled to all the exemptions of a private company as well. Let me straight get started with the meaning of a small company. I'm reading from the definition. And the good thing is that Dr. Mitra in his introduction called keynote. So an entire keynote was already relayed for me. And therefore, he defined section 2. The definition of section 2/85 on the screen. Small company means a company other than a public company. Remember, very important. Small company means a company other than, so if it's a public company, it wouldn't qualify anyway. So it has to be a private company. So small company means a company which is a private company. It can't be a public company at all. And then the further conditions are: paid up share capital does not exceed 50 lakhs or such higher amount as may be prescribed. We'll talk about what is the prescribed amount. Turnover as per P&L account for the immediately preceding financial year not exceeding 2 crores or such higher amount as the central government may specify. For both paid up capital and turnover, the central government actually has prescribed the limits. So it's not 50 lakhs or 2 crores, or still it's been increased, and we'll talk about that as we proceed further. And then it says the definition shall not apply. In other words, the following companies will not be able to take benefit of a small company: a holding company or a subsidiary company. If the company is holding company of somebody, it wouldn't be able to get the benefit. If the company is subsidiary of some other company, then also it wouldn't be able to get the benefit. So the company must be a standalone independent company, neither holdco nor the subsidiary of any other company. We'll get into meaning of this as well. A company registered under section 8, that would mean section 8 is a separate domain altogether. I'm sure all of you are aware. Section 8 pertains to what is called not-for-profit sector, NFP sector, not-for-profit. These entities are there not for profit. They do some, some kind of a social or not-for-profit work, not necessarily charity. It can be philanthropy, it can be social good, social work. Basically, activities which are not intended to make profit. They can make profit. There's no bar on making profits. Purpose, however, is not to make profit, and therefore these companies have a restriction on distribution of profits in any manner, whether by way of dividends or in any other manner. So section 8 companies are a different domain altogether. Therefore, small company domain, small company definition will not include a section 8 company as well. And then comes this little vague word: a company or a body corporate governed by any special act. What's the meaning of this? We'll have to spend quite some time discussing meaning of it. And please do understand that the need for exceptions or exemptions to small company has been at the very root of the Companies Act 2013, because this act, as everyone knows, is based on the recommendations of J.J. Irani Committee. And the J.J. Irani Committee said small companies have to be enabled to take quick decisions, be adaptable and nimble in changing economic environment, yet be encouraged to comply with essential requirements of law and low cost of compliance. The government may prescribe special regime through a system of exemptions. What exemptions are the exemptions granted to small companies sufficient enough? Are they sufficient to motivate people to form companies, move out of the so-called partnerships or LLPs and come to the corporate form? We are not sure on that. But well, there are some exceptions, some significant exceptions. To my mind, there could be a lot more exceptions. I think given the way exceptions have been given in other countries, there may be a lot more exceptions than there are in India. So we will be focusing on the paid up capital and turnover criteria, and then we'll take several examples to understand meaning of this. But let me once again remind you that the back of all the conditions, there is a condition that the company has to be a private company. I'll take examples to illustrate what could be the scope exception for this. So first, it has to be private company, first condition. Number two, it's paid up capital. Now let's maybe read the paid up capital and turnover condition by incorporating the relevant rule. Rule meaning this is rule 212, 21T. So for the word 50 lakhs or 2 crores as given in the section, if you were to superimpose the rule, then the revised definition becomes here, the right hand side. See, small company means a company other than a public company, paid up share capital of which does not exceed rupees 4 crores. Where are we getting this 4 crores from? We are getting it from rule 21T. Turnover of which as per P&L account for the immediately preceding financial year does not exceed 40 crores rupees, 40 crores. So the limits are 4 crores of paid up capital, 40 crores of turnover. Those are the limits. And then the exceptions anyway remain. The holding and subsidiary company will not qualify. Section 8 company will not qualify. And companies or bodies corporate governed by special act will not qualify. Now let's try focusing on the paid up capital. Paid up capital. The limit of paid up capital is how much? Rupees 4 crores. So we said there are two conditions. In fact, I would say there are three conditions. Number one, the company has to be a private company. Its paid up capital must be within rupees 4 crores. Its turnover must be within rupees 40 crores. These three conditions are cumulative. And then there are exceptions. Either of the exceptions may take away the company from the privileges of small company. So conditions are cumulative. Exceptions, any of them might hit and may spoil the privileges of a small company. So what are the three conditions? Once again, it should be a private company. Its paid up capital must be within limit of rupees 4 crores. Turnover should be within rupees 40 crores. It should not be either a holdco or a subsidiary. It should not be a Section 8 company and should not be a company governed by a special statute. Now we are examining the first condition, paid up capital. Paid up capital means what? Paid up capital, as you all understand, equity as equity or preference. Paid up capital means what? Equity capital or preference capital? That's the moment we talk about paid up capital, we are saying it's both equity as well as preference. We'll look at the total of paid up capital, including equity as well as preference. Now question, shall we include premium? For example, a company has a paid up capital of 2 crores, issuing shares at a premium of 20 crores. Therefore, paid up capital including premium is actually 22, but only 2 crores is shown as paid up capital, 20 crores shown as share premium. Are we complying with the first condition? The answer is yes, because we need to look at paid up capital. We're not looking at the price or the amount at which shares were issued. So if the company has successfully been able to price its shares at, let's say, 10 times premium, so be it. We will be looking at only the paid up capital. We will not be looking at the amount paid up on the shares. We'll look at the paid up capital. Paid up capital, meaning something which is actually paid up by way of nominal value of the share capital. What about if company is issued, say, compulsorily convertible debentures? CCD, which would mean the debentures will automatically get converted into shares at some point of time. That's actually what? In real parlance, CCD is also deferred equity. because at some stage the CCD will get converted to shares. It's never going to be redeemed. It's never going to be repaid at all. It is at some stage it would automatically and compulsorily be converted into equity capital. But do we take CCDs as well? Until conversion, the answer is no. Once converted, surely yes. But until conversion happens, CCDs are CCDs. They are not a part of paid up capital. The answer is much simpler when it comes to third point, accumulated profits. Shall we include that? No question at all. So remember, friends, we are not looking at the net worth of the company. We are looking purely at the paid up capital. That would mean the nominal value paid up. Partly paid up shares have become so uncommon these days because mostly people issue fully paid up shares only. But if at all the shares are partly paid up, we will take them to the extent paid up, right? That's the meaning of first condition, paid up capital. The other top condition I have already mentioned, the company has to be a private company. The company should not be a public. Public should be within a limit of 40 crores. King of chartered accountants. So you deal with turnover every now and then. What's the meaning of turnover? The word turnover. Now we don't need to go by the credit side of the P&L account. We are not necessarily supposed to take the entire top line, so to say, as per P&L account. We need to go by the statutory definition. And I'm not sure if Dr. Mitra is at all, because he is on a travel mode, but I'm not sure if he's at all able to participate. But if he is, then I'm sure the institute might have also expressed some views on what exactly is constituted by meaning of turnover. But I'm reading the statutory definition. The definition of the statute says gross amount of revenue recognized in P&L account from the sale, supply, or distribution of goods or on account of services rendered or both by a company during a financial year. So what do we take as turnover? Gross amount of what? Goods or services that the company's sale of goods, sale, supply, or distribution of goods, whatever the company is engaged in, or rendering of services or both. That would mean we need to look at what's the business of the company. The business of the company might be selling goods, might be selling services, might be both. We need to aggregate the gross amounts by sale of goods or sale of services, aggregate them together. That's the meaning of turnover. So one very common question that comes is other income, incidental income. For example, idle funds were invested in or were put into bank, and I've earned some interest by the fixed deposit in bank. I have some investments in some other companies. I've got some dividends from these investments. So will things like other income, that is non-operating income by way of interest or dividends, will it form part of turnover for this purpose? Most humbly, my view would be no. And I would be more than happy to see if the institute has expressed a view on this. But because looking at the definition says sale, supply, distribution of goods or services rendered. If I am in the business of rendering service of lending, for example, I'm in a non-banking finance, I'm a bank, I'm an NBFC. I'm into business of lending. So in that case, surely the interest on loans will be captured. But I'm not in business, I'm in some other business. And there is an incidental non-operating income on account of investment of idle balances, say bank interest. Would I aggregate that? I would very humbly say no. But I'll be more than happy to discuss further. Next one. Fair value gains on. So I'm putting a question which is actually irrelevant in context, because we are talking about small companies. This question is actually coming from Ind AS, and I'm sure you'll all be able to reflect that Ind AS will not be applicable to small companies. Looking at the very side, it's a standalone independent company. It's not having the sufficient net worth to be able to attract Ind AS requirements. But if it does, assuming that the company is doing, for whatever reason, the company is doing fair valuation, will fair valuation gains be a part of turnover? Once again, I would say no. And let's say there is a very high turnover, but in terms of PBT or PAT is a loss. shall we look at turnover irrespective of the net result of operation, whether profit or loss? The answer is yes, we will look at turnover. We are not concerned with the result of operation. We're not looking at whether it's a profit or loss. We'll look at turnover as turnover. And then we're coming to a very important question. Does it matter whether the company is public or private? I said yes, it does matter very clearly. It does matter very clearly because the definition itself says the company has to be a company not being a public company. Therefore, the company has to have the status of a private. It has to be private company. So it does matter very much. What about a deemed public company? So once again, the question is actually irrelevant in context. The question is self-negating. Why? What's the meaning of a deemed public company? Deemed public company means what? Deemed public company means a company which is subsidiary of a public company. The moment it's subsidiary, it's anyway out of the definition of small company. So the question is simply a brain teaser. It's not practically relevant, but nevertheless, when we say the company has to be private company, it must be private company, not a public company or a deemed public company. Let's take some examples to discuss the meaning of small company further. Let's say the company's paid up capital is 1 crore, net worth 20 crores. When turnover is 50 crores, paid up capital 1 crore, net worth 20 crores because shares were issued, say, at 19 crore premium, or they might be the accumulated profits in the company, and the company is achieving turnover of 50 crores. Will this company qualify to be small company? The answer is, I'm sure you would have got the mental answer yourself. This is not a case of small company because the turnover itself is exceeding rupees 40 crores. Same case, let's move further. Paid up capital 1 crore, net worth 20 crores, turnover 25 crores, interest and gains on sale of shares 20 crores. So here the question would be, what's the nature of interest and what's the nature of gain on sale of shares? Supposing there was a strategic investment which has been sold and the company got a gain on sale of a strategic stake, it would be hard to say the company is engaged in business of selling shares. If it's a strategic sale, for example, there was a 10% block of a listed company that we were holding. We sold that and we realized a substantial gain. Can I say that I'm in business of selling shares? It's a strategic investment. So though it's a question based on facts, but I would say generally if it's possible to say that the business of the company was not to engage in sale of shares. The sale of shares was one of a strategic sale, and the interest is interest by way of idle balances, investment of idle balances. We will not capture this other income. We'll be looking at only the turnover of 25 crores. Therefore, in my view, there's a strong chance, I'm not able to give a judgmental answer, strong chance that the company may qualify to be a small company. Third case, the company is a private company, paid up capital 1 crore, turnover 25 crores. It's a subsidiary of a foreign company. It's a subsidiary of a foreign company. Does that make a difference? The company is subsidiary of a foreign company. I'll maybe park this question because we would like to discuss what's the meaning of holding company and subsidiary company. So maybe I'll park this question for a minute and go further. And this is a very interesting point because very often people don't realize that the word holding company and subsidiary company are defined terms in Companies Act. And those definitions are materially different from the definitions used in accounting standards. Accounting standard definition of holdco subsidiary versus Companies Act definition, these are different. So I'll park this question, but surely I'll want to discuss it once I come back. Next point. Question 4. The company is a private company. Paid up capital 1 crore, turnover 25 crores. The company is a JV between two public companies, each holding 50%. So there are two public companies holding capital in my company. My total capital, paid up capital is only 1 crore, but 50-50 held by two public companies. So on the whole, the entire capital comes from public companies, but neither of the companies is a holding company because it's a 50-50 JV. Am I breaching the condition of small company? Paid up capital within limit, turnover within limit. Am I the subsidiary of any of these companies? Answer is no. Am I the holding company? Perhaps not. Am I breaching any other condition? Answer is no. Therefore, in this case, as the company is not a subsidiary, it will still qualify for the exemption. So this answer will be yes. Paid up capital 1 crore, turnover 20 crores. Company has two companies. Two companies below me. Earlier case, there were two companies upstream. Now we're talking about downstream company. In each of which it's holding 50% capital. These companies in turn hold 100% of a third company. So let's say I'm company A. I am holding 50-50 in company B and C. And B and C together are holding 100% of company D. So first question, is any of the companies B, C or D, are they my subsidiaries? In B, I'm holding 50. In C, I'm holding 50. B and C put together are holding 100% of D. Is D A's subsidiary? Answer will be no. Is B the subsidiary of A? The answer is no. Is C the subsidiary of A? The answer is no. So once again, we are not breaching the condition of being a holdco or a subsidiary, and therefore here as well the exemption, friends, would be available. Next point, think of an LLP having a paid up capital of 20 crores, turnover of 20 crores. Will this qualify to be a small company? I think once again it's a trap question. I'm trying to trap you because we're talking about LLP, which is anyway not a company. The Companies Act itself is not applicable. The question of therefore the LLP being a small company or large company does not arise. As I'm yet to come to the question number 3, which is pertaining to deemed public company because of being subsidiary of a foreign company, and that brings us directly to the meaning of what is a holding company, what is a subsidiary company. So remember, these two definitions are intertwined. One is to read one is to read the other one after reading the second one. So let's first understand, in order for a company to be holdco, it must have a subsidiary. Now see that meaning. Holdco in relation to one or more other companies means a company of which such companies are subsidiary companies in relation to one or more other companies. That would mean if there is a holding company, it has to have subsidiaries. And then it goes further to say that the expression company here includes a body corporate. That would mean even if it's a body corporate, what's the difference between a body corporate and a company? A company means a company under Companies Act. Body corporate might be any body corporate. Therefore, even a foreign company is a body corporate. A foreign company is not a company under Companies Act, but it's a body corporate for sure. And then we go to section 2/87, which says, in relation to any other company, that is a holding company, means a company in which the holding company controls composition, has 50% or more voting rights, or it's a what you call step down subsidiary. So question is, as far as the holdco is concerned, the holdco need not be a company under Companies Act, because the definition clearly says the holdco may be a body corporate as well. So in the example that I had taken, this example, I had a private company. The private company is a subsidiary of a foreign company, which is a body corporate. The body corporate is therefore a holdco. My company is anyway a company. It's falling under the Companies Act. So I'm falling in definition of 2/87. The holdco is falling in definition of holding company. And therefore, I am being a subsidiary company in terms of 2/87. I do not qualify to be a small company. I don't qualify to be a small company. Will I become a deemed public company? Answer is no. Because as for deemed public companies, long time back when the act came, the MCA clarified that for deemed public company definition, we will look at companies which are Indian companies. We will not look at foreign companies. For example, IBM India Private Limited is still private limited. Google India is still private limited. It's not limited. All of them are subsidiaries of foreign companies. That's because of a very old clarification from MCA, but for this purpose, for the purpose of small company definition, because it's subsidiary of a body corporate, it would therefore not be eligible for the exemption. So we've taken the meaning of each of these three things: public company, private company, paid up capital, and turnover. And now we look at the three carve-outs. We have taken one already, holding subsidiary we've seen already. Now we look at the other one, Section 8 company. Section 8 company means what? A company which is registered as a Section 8 company. Erstwhile Section 25. Section 25 of the Companies Act 56. Section 8 of the Companies Act 2013. The company has a valid registration, which would mostly mean the company would not be writing the word limited or private limited after its name, because it's formed for social objectives. It's a not-for-profit entity. So the company has registration under Section 8 or as well Section 25. It would not be eligible to avail of any of the exemptions of a small company. Now I'm coming to a very, very contentious part, and I'm aware that many very articulate, very respectable chartered accountants have different view on this. So I'm aware that the views that we express are different from the views expressed by others, but I'll explain the basis for my view. Now it's humbly it's an opinion. It's my opinion. I would be able to state the reason or the background for the opinion. I'll be able to say why I say so, but then it's up to you to judge whether you like to take, the view that I'm expressing or the view that others are expressing. So what's the view that some people are expressing? This is particularly in case of non-banking finance companies, because that's where the question of DMAT and the question of mandatory CARO applicability, those questions come. And some people say that because the law says companies governed by a special statute. So when it comes to NBFCs, there's a special statute governing the company. What is the special statute? RBI Act. The NBFC got its registration under RBI Act. So if the NBFC is registered under RBI Act and the RBI has power to regulate them, then it's an entity regulated under a special act. It's governed by special act, not regulated, governed by special act. That's the view that people are taking. Now, on the contrary, I am saying that this expression, governed by special statute, is not something new. It was there in Companies Act. It's been there in Companies Act 2013. It was there in Companies Act 1956. It was there in Companies Act 1913 as well. And it has always been there in corporate laws, written about 200 years back or longer in the UK. This expression has always been there. So this expression is found in Halsbury's Laws of England. It's found in Companies Act 56, 2013, 1913 as well. So this expression has always been there. And what is the meaning of this expression? The companies which are created under a royal charter. Remember that sometimes government creates companies under a special charter. For example, Damodar Valley Corporation under a special charter. Life Insurance Corporation enacted a separate charter. State Bank of India under SBI Act. Governed by special statute, meaning it was a product of a special statute. There was a statute separately governing it. Can I say that in that sense, non-banking finance companies are a product of RBI Act? Non-banking finance companies are governed, regulated by the RBI Act for sure. But for that matter, there are several other sectoral regulators. Every merchant banker is regulated by SEBI. Investment advisor is regulated by SEBI. Stockbroker regulated by SEBI. Any securities intermediary regulated by SEBI. Telecom companies regulated by TRAI. Insurance companies regulated by RD. There are sectoral regulators. A company, for example, in medical business may have a medical regulator. Regulations may be there by sectoral regulator. That does not mean the governing law, the mother statute, governing NBFCs is any different from the Companies Act. So in my view, it's not right to say that merely because NBFCs come under separate they derive the right to carry financial business from the RBI. In the same way as a stockbroker derives his right to carry broking business from SEBI registration. Similarly, investment advisor gets his right to carry advisory business under SEBI registration. Portfolio manager, merchant banker, all kinds of intermediaries. So they derive the rights from a separate regulation. They are subjected to the separate regulation as well. But I cannot say the governing statute is any different from the Companies Act. And you can see there are some rulings that we're citing here. There are some quite old rulings. Second category with large and growing one, which is economically very important. Companies that are known as public corporations. These are each of these are creation of royal charter. These are very old rulings, so they pertain to pre-independence rulings. So special act of parliament, meaning it was created under special act, and that was the meaning of these companies. Once again, in Samachar Bharati, if there is a special act which is complete code in itself, complete code, then only we'll say it's an entity governed by special statute. I cannot say the RBI Act is a complete code by itself. RBI Act is merely governing the financial business. For example, appointment of auditor, or let's say for the audit of accounts, filing of accounts, registration of a company, change of registered office, appointment of directors, issue of share capital. All of these will happen under the Companies Act. So I cannot say additional regulations apply from the RBI, but RBI is not the governing statute. And once again, we could probably go on detailing that, but like I said, the purpose of enactment of RBI was to oversee the operations of banking institutions. Subsequently, Chapter 3 extended the ambits to non-banking finance companies as well. It's an NBFC is given, it's engaged in distinct operations. Those operations, that is financial operations, are regulated by the RBI. To the extent a non-banking finance company does financial business, it would be regulated by the RBI, but not, I wouldn't say the RBI Act becomes the governing statute for an NBFC. I'll briefly deal with the evolution of the definition as to how this limit of 4 crores and 40 crores came. It was 15th September 2022, little over 2 years back, that the definition was increased. Earlier it was 2 crores and 20 crores, and the MCA then increased it to 4 crores and 40 crores, the thresholds of the paid up capital and turnover definition. Now, significant question. Suppose the turnover of the company increases above 40 crores in FY 14-15. Is the company not a small company in FY 14-15 itself? Will the company cease to be a small company in financial year 14-15 itself? Answer would be no. Why? Because as you recollect, definition is clearly saying turnover as per financial statements of the previous year. So in 14-15, we look at 13-14. In 15-16, we look at 14-15. Therefore, if the turnover is crossed rupees 40 crores for the first time in 14, the company would lose the privilege of being a small company only in the next year. What are paid up capital? If the paid up capital is increased above 4 crores, say in 14-15, can I still say the company will be entitled to the privilege and it's only next year the company would lose the benefit? See, in case of turnover, the law is clearly saying turnover as per last financial year. It's not saying the same thing with paid up capital. For turnover, I might have to see the financial year. Paid up capital, I don't need to. Paid up capital is something which is known at a point of time. Turnover happens over a period of time. Therefore, I need to go for financial statements. Paid up capital is something which is known instantly, because if I increase the paid up capital, I know the paid up capital is increased, and therefore, in our view, if the paid up capital increases above 4 crores, the moment it increases, that is the month or the day when it increases, the company would cease to be entitled to. As for turnover, we're looking at last year. As for paid up capital, looking at the paid up capital at the relevant point of time. Now, because we were initially talking about, Nishaji wanted specifically to talk about small and SMEs, as the small and medium companies too. So while we will not be discussing at length the industrial policy on SMEs or the privileges for SMEs, because our focus is Companies Act, I'll anyway compare. As you understood, the definition of paid up capital and turnover for small companies under the Companies Act, 4 crores and 40 crores. Relative to this, for small companies, turnover definition under Government of India industrial policy definition is 50 crores. Micro is different, 50 crores. Medium companies, 250 crores. And that definition does not look at paid up capital. It looks at investment in plant or equipment. So therefore, a company may still be an MSME, SME. It may still, and by the way, the industrial policy is not concerned with whether the company is public company or private company. So quite often situations may be that the company qualifies to be SME. It has a Aadhaar registration as SME. It is entitled to all the benefits of SMEs. However, it does not qualify to be small company as per the Companies Act. Now I'll get into what are the privileges or exemptions for small companies. We'll focus on each of these. I'll quickly do first a inventory of what all benefits there are, and then discuss each of them briefly. First, Dr. Mitra, remember, started with this. Dr. Mitra got sensitized about this topic because one of his auditees prepared a financial statement without a cash flow statement. So cash flow statement is not required for small companies. Small companies have the exemption from preparing cash flow statement. Then for the annual return and sizing of the annual return also, there are some privileges for small companies. Likewise, contents of board report. Lots of contents of board report need not be there in the balance sheet in the board report of small companies. They are there in the board report. They may be there in private companies as well. Rotation of auditors. Technically, I can say 139/2 rotation of auditors is not applicable to a small company. But given the fact that a small company would be reasonably small, even otherwise, the thresholds of a small company definition would quite likely not be applicable to small companies. Therefore, in any case, this is not, I would say, great benefit, but technically, yes, rotation of auditors is not applicable if the company is a small company. Authentication of documents, that is certification of documents. I can do a self-authentication instead of going to a certifying professional. Incorporation fees and filing fees are also lesser. Then fast track merger is applicable. This is important once again. If you go for a merger, in case of small, if the two companies, transferor, transferee, both are small, I can avail of the fast track merger scheme, which means I don't need to go to NCLT. I can achieve the merger right by application to the central government. Meeting the board of directors. Normal companies, we need 4 meetings, board meetings. Small companies, we only need 2. So lesser of minuting exercise for you, only 2 minutes to be written. CARO is not applicable to small companies. As auditors, this is something that all of you are instantly concerned with. If it's a small company, qualifies to be small company, CARO does not apply. I'd mentioned this is probably one of the most significant regions for people's interest in this webinar today. DMAT. Mandatory DMAT of shares, securities of private companies does not apply to small companies. As long as the company is a small company, it may continue to have its securities in physical form. I'm not sure how long, I don't know, because the way the government is going about it, I'm not sure if it would probably be long before the requirement is extended to small companies as well. But as of now, small companies have this privilege. We'll discuss each of these, by the way. And lesser penalties. If you do a breach of provisions of law, the penalties for small companies are less. So let's first take up each of these very quickly. I would surely want to spend some time in interaction with all of you, so I'll reserve some time, assuming that you have questions. And please keep your questions handy. Please keep populating the questions on the chat board. So Nishaji can maybe let me know what questions there are once we have done the primary coverage.
So,
Right.
sir, would you like to take up the queries as of now, or sir, after just
No.
completing this
Nishaji, let me
portion, sir?
run through the exemptions as well, and then maybe we can take up the question. You are saying that you have some questions?
Yes, sir.
Some or many?
Sir, some around 10 questions, sir.
Achha, theek hai. Very good, not a problem. So if 10 people have some issue, others are all very comfortable. So it's very good for people to be comfortable. It's very, very good, because that's exactly what is peace means, that you're comfortable, you don't have questions. But if you think that you still have questions, something is lurking in the mind, something is bothering you, please do flag your question to Nishaji. Let's start with the cash flow statement. So cash flows, as you understand, Section 2/40 defines financial statement to include balance sheet, P&L account, cash flow statement, and it gives an exception saying in case of small companies, financial statements may not include a cash flow statement. So if you're preparing the financial statement of a small company, you may just go ahead with balance sheet, P&L account. Statement of changes in equity anyway is not applicable in case of IGAAP companies. Explanatory notes, in any case, the notes to balance sheet, P&L account, of course, but cash flow statement not required. Is it a great privilege? I think little bit lesser of work. You don't need to do a lot of work in preparing. Is it a lot of work actually? I don't think so, but well, whatever is the value of not giving a cash flow statement, you can actually not give a cash flow statement. To the next point, abridged format of annual return. So the government has the power to notify abridged format. Abridged format was notified, and this is what you call MGT 7 versus MGT 7A. Several particulars which are there in MGT 7 are not there in MGT 7A, which is the abridged format. And 7A may be signed either by CS, or if the company does not have a CS, it can be signed by any director, which means piece. So that's the abridged format of annual return. And as you can see in the so-called abridged format, the text which you are seeing in red, the red text, not a lot, but there are some exceptions for private companies. So, well, shares, the question of listing does not arise at all. Holding subsidiary companies anyway don't exist. That's anyway relevant. Details of directors and KMP. So remuneration to directors I have to give. KMPs I don't need to give. Committees of board, in mostly for small companies, committees are not even needed. Actually, for small companies, we don't need audit committee. We don't need nomination remuneration committee. So we may not need these committees at all anyway. So when the exceptions are actually sort of, quite intuitive exemption, because it's not a great liberty. These things are actually not applicable to small companies, and they have been sort of exempted in the so-called abridged format. Disclosures in board report, once again, lots of things which need to be there in the board report of other companies have been excluded in the case of independent director. Independent director is not even applicable to for small companies. Remuneration policy section 178 does not even apply. Amount proposed to be transferred to reserves. This is actually now discretionary. Amount recommended to be paid as dividend. Well, for small companies, mostly it's very, homegrown dividend policies. CSR policy, well, if the profit amount is ₹5 crores and above, I think the only reason why small companies may be covered by CSR might be profit. Turnover net worth, surely not. Profit if it exceeds 5 crores, which is also quite less likely, but if at all it does, well, CSR may be applicable. CSR is applicable. CSR policy and details of initiatives do not need to be there as a part of board report. Performance evaluation of board, once again, not applicable for small companies. Conservation of energy, etc. The details are irrelevant for small companies. Particulars of loans made under Section 186. Do private companies enjoy exemption from Section 186? I would say no. So 186 may be applicable to private companies, may be applicable to small companies as well. There is no generic exemption, but you may qualify because of some of the exceptions given in Section 186/11. Change in nature of business, not necessary to be given. KMPs, once again, mostly comes from Section 178, etc. So that's also not applicable. Risk management does not apply. Cost records mostly will not be applicable. Integrity, experience, etc. of IDs. IDs are not even there in case of small companies. Therefore, this is also a very intuitive exception. Next, adequacy of internal financial control. Dr. Mitra mentioned that internal financial controls are applicable in case of listed companies. Small company, question of being a listed company does not arise. Therefore, that's also automatically taken off. Performance of subsidies, but this small company can't have a subsidy. Therefore, that's also irrelevant. Companies which have ceased to be subsidies, once again, irrelevant. Constitution of the committee under POSH Act. Details relating to deposits, including details of default. Mostly, small companies will not be deposit-taking companies anyway. Deposits which are not in accordance with Companies Act, that also question does not arise. IFC is not applicable. Details of application pending under IBC. If at all there is an IBC against which it would qualify to be a small company, quite likely. It would be therefore covered by SME provisions of IBC. So lesser thresholds, lesser rigor of provisions, but in any case, details of applications, etc. under IBC will not need to be given. Valuation at time of one-time settlement, etc. These are also not required in case of small companies. So these were some details which were not needed in case of small companies. I had mentioned about rotation of auditors, mandatory rotation, 5-year term and mandatory rotation. It's anyway applicable to listed companies, unlisted public companies having paid up share capital of 10 crores, private companies with paid up share capital of 50 crores, or borrowings of 50 crores or above. So quite likely a small company will not anyway be hit by 139/2 requirement, but nevertheless, unlikely that it would be hit, but even if it's hit, it would not be required to follow because there's a carve out from rotation. Also, maximum number of audits, another very important point from chartered accountants. Maximum number of audits, 20 audits per auditor, but that definition does not include. I'm not sure of what the institute's own internal imposition. As per statute, small companies and private companies with paid up share capital less than 100 crores will not be included in the limit. Caro report is also not applicable to small companies. You can see very clearly, Caro is not applicable to banking company, insurance company, Section 8 company, 1% company, and small. And a private company satisfying each of the following conditions. In any case, a small company is not covered by the requirement of Caro. So Caro definition also does not apply. Caro applicability does not extend to a small company. Moving forward, lesser number of board meetings. Other companies need to have 4 board meetings. Small companies may just have 2 board meetings. And the gap between 2 board meetings may be at least 90 days only. That would mean you can actually do 2 board meetings, one in the month of June, other one in the month of, let's say, 1st October, and that's it, and be free for the rest of the year. And you don't need to space out the board meeting, actually do with a narrow gap in between and just do a compliance with the requirements of board meetings. This was one of the very, very important provisions. Rule 9A, which is applicable to DMAT. These are coming from Section 29 of the Companies Act. So public companies were covered by Rule 9A, private companies were covered by 9B, and when 9B was extended to private companies, it said small companies will be excluded, to the exclusion of small companies. So Rule 9B is now applicable to all private companies with the exception of small companies. Small companies don't need to go for mandatory dematerialization. Now, what exactly is the mandatory demat requirement? Securities of directors, promoters, KMPs, further issue of securities only to be in demat format, transfer and subscription to further shares only in demat format, half-yearly filing of PAS 6 reconciling physical and demat shares, and facilitate demat for existing issued shares. These are the mandatory obligations on every company covered by Rule 9B. But like I mentioned, Rule 9B does not extend to a small company. So if you're a small company, you can be snug, you can be safe, you can be secure. You don't need to go for mandatory demat. What if you do not do or do not comply with Section 29, Rule 9B? It amounts to breach of Section 29, which is leading to a general penalty section of Section 450, which means there's a daily fine. Apart from one-time fine, there's a daily fine as well. So I would suggest, please advise your clients if they are either falling under the exemption of small company. Otherwise, don't risk the breach of Section 9B. You would probably be getting a lot of broadcast mail from different agencies. And because the data for these companies is very easily available with MCA, it would be very, very easy for the MCA to launch prosecution. I hope all of you are aware that MCA is these days using a regulatory technology for finding gaps in law. So using technology, some kind of artificial intelligence tells the MCA that there is a breach and it would auto shoot a show cause notice. I was mentioning several documents which do not require pre-certification. These are many documents listed there. They don't need pre-certification. That would mean the documents can be certified by either or if the company is a CS, then the CS, or by a director. So they don't need to go for a professional certification. Filing fees also are lesser. For several places, filing fees are like initial registration up to 10 lakhs, only 2,000 rupees. And application for filing appeal, for application to central government for increase of share capital, also the slabs are less. So both at time of initial registration as also at the time of increase, the slabs, you end up paying lesser money. And then comes the question of lesser penalty. So if you're paying any penalty, why I'm referring to penalty, not fine. Penalty, meaning under 446B. If you're liable to pay penalty, the amount of penalty in case of small companies stays not more than half of the penalty specified in the respective provision. That would mean you're liable to exactly half. And there's an absolute threshold as well, absolute limit as well. 2 lakhs for the company and 1 lakh for the officer in default. तो भाई अगर आप स्मॉल कंपनी है तो और जगह 10 लाख 20 लाख लग सकता था आपको, लेकिन 2 लाख में काम चल जाएगा. और इन केस ऑफ डायरेक्टर्स ओनली 1 lakh. Now let's talk about fast track merger as well. Section 233 deals with fast track mergers. So fast track merger is as of now applicable in case of 2 or more startups, 1 or more startup with 1 or more small company, 2 or more small company, or a holding and its wholly owned subsidiary. So we are actually talking about this one. Sorry, 2 or more small company. A merger between 2 small companies may be covered by fast track scheme. It does not need to go for the normal NCLT route. So there's no need to approach the NCLT. You can do a application to central government. There's a mandatory disposal of fast track within 60 days. I'm not sure whether that actually happens because typically the government may come up with some questions. Unless there are questions which are not answered, the merger can be done within 2-3 months flat. without having to go to NCLT, lesser expense. Now, you remember to here also remember that even if there are two small companies, as a result of merger, we have a large company. Post merger, the two companies will become large. They will cease to qualify for small company definition. Can the company still avail the benefit? In my view, very clearly, yes. So there's nothing denying the benefit of a merger. If the two companies are otherwise small companies, post merger, they might become large. That's not an issue. So I'll quickly now talk about exemptions applicable to private companies as well. I'm zooming past it. I will not spend time here. Like I mentioned earlier, every small company is by definition a private company as well. Every small company will also be eligible for the privileges of a private company, and therefore, whatever exemptions are applicable to private companies extend to small companies too. What are the exemptions for private companies? First, shareholders may vote. Under RPT approval, shareholders may vote even on a matter where they are interested. Constitution of CSR, I mean, private company having only 2 directors can constitute CSR committee with only those 2 requirements. Unlike public companies, we need to have at least 3 directors. Private companies can do only with 2 directors if the company has only 2 directors on its board. Register of members, very infrequently used provision. There's no need to go for general meeting approval for remunerating the managerial personnel. You can pay what you like without being hit by any of the limits. The limits under section 180, powers of the board, are not, which is very important because quite often taking a loan, disposal of undertaking, etc. These are provisions which require special resolution, but these are not applicable to private companies. Disclosure of interest in case of interested directors, section 184 does not apply to private company. This one is not very important, so I'll leave that. 162 is also not very important. 160 is also not important. General meeting, that is several provisions relating to general meetings. The private company may define its own provisions by way of its AOA. Private companies may create provisions by its AOA. For example, in case of a normal company, what's the minimum length of notice of meeting? Notice of general meeting, what's the minimum length? 21 days. A private company inserts a provision in the article saying that my general meeting can be called with 7 days notice. That is, I'm deviating from the 21 days notice requirement. I'm saying for me, it's just 7 days. Is that okay? Is that kosher? Answer is yes, because a private company is permitted to have its own provisions dealing with meetings, quorum, etc. Filing of MGT 14, 117 3G, which connects with the MGT 14 filing requirements, not applicable to private companies. Independent directors, of course, not needed. Very important provision for acceptance of deposits. I think for chartered accountants, once again, very, very important that while other companies cannot accept deposits from shareholders, private companies may. This is coming by way of a notification within a limit, which is, I will just be putting it on the next slide. Private companies may accept shareholder deposits as well within certain limits. We're just discussing that. And sections 43 to 43 and 47 dealing with share capital also don't apply to private companies. ESOPs, once again, not very important. Let me just quickly come to the deposit restriction. Up to 100% paid up capital, free reserves and securities. Private companies may accept deposits up to 100% of paid up capital. And then for startups, they may accept deposits up to 5 years. But the conditions, 3 conditions need to be satisfied. Once again, company should not be subsidiary or associate of another company. Its borrowing should not be 2x or rupees 50 crores, whichever is lesser. It shouldn't have committed a default in repayment of subsisting borrowings. If these conditions are satisfied, a private company may accept deposits from shareholders up to 1x, up to 100% of its paid up capital, free reserves and securities premiums. It's almost like net worth. Up to 100% of NOF, net owned funds, net worth. Private companies may accept deposits from shareholders as well. So friends, this was broad coverage. And I think at this stage, I would look forward to Nishaji, whatever questions she has already. And if participants want to put any further questions, please feel free. Nishaji, over to you.
Yes, sir. Sir, I'm just sharing on the chat box whatever queries I have received. So here I've just shared with you the first query. What are the specific provisions for the disclosure of financial information in the annual return of a small company?
So Nishaji, we displayed this on the screen sometime back, showing the information which is not required in case of small companies. So this, I believe, was taken care of during the presentation. If the query has any further specific question, please feel free to come back. But otherwise, this was discussed during the presentation. I may put the screen once again, but I think it was covered already. And by the way, I'll be happy to pass on the presentation to Nishaji. And Nishaji in turn may want to place it for the benefit of all the participants, whichever way.
Yes, sir. It will be shared with our participants, sir. The
Absolutely.
presentation.
Very good. So you can get this information from the presentation as well. Can a small company have a foreign subsidiary? Now, remember, when we discussed the definition of holding company, we said holding company may be a body corporate. This is a very interesting question. Whoever has asked this question, very interesting question. And let me once again go to definition of subsidiary. This is, I'll maybe put this definition on screen once again. But whoever the query is, thank you for asking this question. Quite a tricky question. Subsidiary. In relation to a company, that is to say holding company, means a company in which the holding company, means a company in which the holding company controls composition, etc. So unlike section 2/46, this provision that the company includes a body corporate, it's not there in section 2/87. Therefore, if the company has a foreign subsidiary, I'm inclined to say that it would not be disqualified to have the benefits of a small company, because foreign company is not a company. You remember saying in relation to any other company that is a holding company, means a company, means a company in which the holding company blah 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 blah. So in other words, a subsidiary has to be company. The extension of the definition of holdco to include a body corporate apparently is not there in section 2/87. So it's possible to contend that if the company has a foreign subsidiary, the subsidiary is not a company, and therefore you are not the holding company. So I would say it's possible to contend that the benefit would still be applicable. Nishaji. Next question, Nishaji.
Yes, sir. It is on your screen, sir. Can a one-person company become a small company?
See, given the fact that the privileges of one-person company and small company are almost similar, I mean, one-person company becomes a multi-person company itself is by and large eligible for similar benefits as a small company. So I'm not sure what could be the motivation to, I mean, if a one-person company converts into a multi-person company, if it's satisfying the definition of small company, it may still be eligible for those benefits. But an OPC itself trying to say that I am a small company as well, I think the contrivance does not really have much relevance because the privileges are largely similar. So to my mind, I think there's not much of merit in seeking that privilege. Nishaji.
Yes, sir. Next query. Can a small company have foreign directors?
I don't see there's a bar. Can a small company have a foreign director? Well, yes. Can all the directors of a company be foreign directors? Answer would be no. Because the company that requires at least one resident director. So you have one resident director, you have other foreign directors. I don't see a bar. Now the question is, can the company have foreign, what you call, wholly whole-time directors, they are also subject to adherence of Section 196. I don't say bar. That would mean, generally speaking, I don't say a bar. But please remember that now the policy of the country clearly says for countries which are sharing the land borders with India. So I hope you are getting what I'm trying to say. So don't get a director from either Bangladesh and more importantly not from China either. Because these are these days permitted only with Home Ministry approval. So normally question is, can a small company have a foreign director? That my answer would be yes, it can. Can the foreign director be a whole-time director? Subject to provisions of 196, I would once again say yes, possible. But if it's from a country which is sharing land borders, please do adhere to the approval requirements.
Next query, sir.
Question does not arise. Can a small company raise funds to public issue? See, the moment you go for a public issue, we're talking about how much paid up capital, 4 crores. See, now, even if you go for SME IPOs, I think SEBI has recently increased the ticket size. So, I mean, I think, let me put it this way differently, that the moment you go for, say, an SME IPO, you would be covered by the provisions of LODR. And by the way, there were a lot of exemptions in LODR earlier, which are now proposed to be. In fact, the SEBI board meet recently, I think on the 18th of December, the board meet of SEBI has already passed a decision to remove a lot of exemptions for SME IPOs. And in fact, it also inserts several conditions for SME IPOs. So to expect the company to be a small company and still be able to come with SME IPO, I think would be unrealistic. So while there is no specific bar, I think, by the way, also the moment you issue IPO, you're not a private company anymore. No? So I think once again, the queries can probably do a little thinking. If you're raising money by public issue, that would mean you are doing a breach of the conditions of private company. Private company cannot offer securities to public at all, right? And therefore, the company ceases to be private company. The moment you cease to be private company, you cease to be eligible for exemptions as well. So therefore, the answer would be no. Flatly no, because it becomes a public company. It has to become a public company. Before it raises any securities from the public, it has to be public company. No private company can offer securities to public at all in any form, shares, debentures, or whichever other way. For all my chartered accountant friends, I would very strongly say, please be very careful, because quite often people, the urge to raise money from the public can be quite strong, and very often people try to raise money from the public directly, indirectly, ulta pulta kaam karke na, people want to raise money from public. So if you are the advisor, auditor, or you are whoever, please advise caution against it. I am saying this with whatever experience I have in hand at my disposal. I'm saying, whenever anyone raises money from the public in any form, retail public, general public का पैसा उठा रहे हैं, तो आप समझिए आप अपने आप के लिए समस्या मोल ले रहे हैं, क्योंकि देर सबेर समस्या आनी. Imagine you are a small company owner, you have fewer compliance requirements, relaxed audit norms. How does this impact your day-to-day operation? Day-to-day operations, and I can focus more on my business. Interesting question, whoever has asked it. Interesting questions. I appreciate the question. So since I spend less time in compliances, I can spend more time in doing business. That's the whole idea. Remember, that's what JJ Rani committee said, that these companies need to be nimble. Nimble matlab they need to be more efficient. उनके पास माने compliances में time कम लगे और value creation में time ज़्यादा लगे. They'll be able to probably create more value. That's the whole objective. That's the whole objective of the relaxation. So that's the answer. More time in value creation. One new, okay. Suppose a public company wants to reduce its compliance burden and become a small company. Is it possible, and why or why not? Nisha ji, by the way, I must say, ये जो participants हैं,
Yes, sir.
they are asking very, very intelligent questions. माने
Yes, sir.
शाम के टाइम में लोग इतने intelligent question खोज के ला रहे हैं. I'm really, I mean, Appreciative. Very, very nice question. So this is again a very nice question. Suppose a public company wants to reduce compliance burden, become a small company. सबसे पहले क्या करना पड़ेगा? Public company has to convert itself into a private company. You have to follow the process of conversion of public to private, for which you need to go to ROC, get approval. And so that's part one. You've done one stage. From public, you become private. Once you've taken approval, change your articles. You change the articles, you followed the process of conversion from public to private. That's stage one. Stage two, now you need to bring down your, assuming the paid up capital was exceeding 4 crores or turnover was exceeding 40 crores, you need to scale them down. I can think of scaling down the paid up capital. How do I think of scaling down the turnover? और by the way, paid up capital भी scale down करने का तरीका अभी बहुत कम हो गया, because buyback of shares, as you understand, after 1st October attracts different problems. So I can go for reduction of capital maybe, but otherwise. So issue basically, yes, if the paid up capital and turnover were within limits, I can convert myself from public to private, in which case I can once again, I can start enjoying the privileges of a private company. Further intelligent question. And as an entrepreneur in a small company, you want to raise capital, but are limited to private placement. How to proceed here? So I think I just mentioned there that as a small company has to be private company. Private company, the only option is to do a private placement. And I'm sure the chartered accountant friends present here might be aware that recently ROC Delhi as well as SEBI have issued several rulings against platforms which offer shares to people in general. I say बहुत सारे platform in the age of technology, you find a lot of platforms trying to sell shares. You can buy shares in unquoted shares of private companies or shares of companies which are yet to go to public. So there are prosecutions already. ROC has imposed penalties on several people. SEBI also recently passed order for several such platforms. So I would like to make it very clear so everyone gets it extremely clear. In no way, in no form can a private company make a generalized offer for any securities, not just shares, any securities, share or debenture, any security. Generalized offer. You cannot make a general offer to people in general. What's the meaning of general offer versus private placement? Assuming I'm throwing a party at my home. Say I'm throwing a party at my office or my home. Who do I invite? Who do I expect? Only people who I invited. If I'm throwing a party at my home or my office, I'm expecting only those who were invited by me to come. That's a private placement. As opposed to that, supposing I am opening a shop. Anyone can come. So the moment it's anyone, it becomes a public offer. A lot of time people look at number, 200 का limit. से 200 का limit से मतलब नहीं है 200 हो कि 100 हो कि 50 हो कि 20 हो. If you have extended a public offer, that is invitation to people in general, it would still be a public offer. In which case, provisions of Companies Act, SEBI, as well as it's like I mentioned, raising money from the public is a huge offense. So yes, the answer to the question is you cannot raise money from public. You have to be content with private placement only. If you want to do public sourcing, convert yourself into public company. Then also, if you're trying to make a public offer, you have to do it through the public offer route only, either SME IPO or normal IPO. There's no other way. There's one, if you're wanting to raise debt, there's one more option. You can go to what is called OBPP, online bond placement platforms, where you can issue bonds, get them listed, and the listed bonds may then be traded on OBPPs, online bond placement platforms. There are several of these platforms these days. Nisha ji.
Sir, would you like to take up more queries or would you like to continue, sir? Because we are having still more queries, sir, with us. Around again next 5 to 6 queries are there with us.
तो मेरे ख्याल से तो I think my content was anyway done, so I'm now looking for queries only.
Okay. So,
So
sir,
if there
I'm
are
going to
queries,
read the queries because I'm having the printout of the queries with me as of
Acha,
now.
no
Yeah.
problem, no problem at
Yes,
all.
sir.
And other participants, if you have any questions at all, please feel free to post the questions.
Yes, sir.
Ji,
Sir,
Nisha.
yes, sir. The query is, sir, is there any exemption to small company from complying with accounting standards?
No, there isn't. I mean, AS would still be applicable to best of my understanding. I think I don't think there's any carve out from accounting standards. That's so accounting standards is not exactly my domain, so I wouldn't be able to authentically say. But my understanding is accounting standards are the same. Caro is not applicable, of course, but accounting standards, to best of my recollection, I think the same accounting standards are applicable.
The next query is whether NBFC registered under RBI capital below 4 crores and turnover also below 40 crores is small company or not?
Nishaji, this is something that we discussed at length during the
Yes, sir.
deliberations. And I had mentioned that, in my view, it's wrong to contend that NBFCs are governed by special statute. They're regulated by the RBI, but that does not mean they're governed by special statutes. There is no denial of the benefit of small company for NBFCs. Subject to three conditions: private company, paid up capital within limits, turnover within limits. They may still be eligible for all the privileges of a small company.
The next query is if statutory auditor issues cash flow to small company, whether is it a non-compliance and whether can it be a non-compliance under ICAI guidelines and rules?
No, Nishaji, because you may not give a cash flow statement. But if you give it, are you violating anything? No, surely not. It's not required to be given, but if you're giving it, you are being more, you're being more transparent. So nothing wrong in that.
The next query is, in case small company has done demat of shares, which I've already discussed many times, sir, during the session itself. So here the question is asking, in case small company has done demat of shares voluntarily, then does it require to file PAS 6?
I would say no, because the requirement of PAS 6 is applicable to companies covered by Rule 9B. Small companies not covered by Rule 9B. So if you've voluntarily done demat, that's your choice. I don't think you are required to file PAS 6.
Okay, then sir, next query is whether for small company penalty for filing of documents such as balance sheet and annual return or any form is 50%.
Yes, I'd mentioned half the penalty, correct?
Right.
Yes.
Okay. Next, sir, gap between two board meetings should not be less than 90 days. But suppose some matter comes up which can be decided in board meeting only within 90 days of last meeting. So if board meeting is held before 90 days, will it be a violation?
Okay, Nishaji, let me just illustrate the point. So let's say you do a board meeting on the 1st of June. You do another board meeting on 1st of July within 30 days. What is the requirement for small companies? I need to have how many meetings? I need to have at least 2. I did one in 1st June. I did another one in 1st July. Can I say I'm done for the year? Answer would be no, because the 2 board meetings that you need to hold, the gap should not be less than 90 days. That would mean we will not count the 1st July meeting. You will need to do at least one more meeting after a gap of 90 days from 1st June. So there's nothing wrong in holding more than 2 board meetings. There's nothing wrong in having a gap of more than 90 days. The requirement of 2 board meetings will be those meetings which have taken place with a time gap of at least 90 days. So no violation, just that you need one more board meeting.
The next query is if a private company is fall within the definition of small company, as well as also fulfill the conditions of Caro applicability. So would Caro be applicable on it?
You're saying that despite it being a small company, it is otherwise falling under Caro?
Yes, sir. A private company is falling within the definition of small company as well also fulfill the conditions of Caro applicability.
So I'm not able to understand if that is possible. Let me just scroll through the requirements to see if that's actually a possibility. Caro. So it's not applicable to a small company. It's not applicable to private companies satisfying the following conditions. Not being subsidy holding, this is applicable to a small company as well. Having a paid up capital reserves and surplus of not more than 1 crore and not having total borrowings exceeding 1 crore from any bank. So these are, all of these are what you call separate exclusions, separate exemption. That would mean if I'm a small company, I don't need to see the, I need to see only this part. I do not need to see this part. Therefore, if the company is a small company, irrespective of the private company not satisfying the following conditions given in the next bullets, I can still claim exemption from Caro. So to my mind, if it's a small company, it would still be exempt from Caro.
Right. Okay, sir. Sir, rest of the queries are of generic nature. We can continue with the topic. Till that time, if any further more queries we may receive, then we can discuss that too also, sir.
Nishaji, from my side, the content is already taken care of. So if people have questions, we can still discuss. If people don't have questions, I think they're very wise people because they did understand that after all, the discussion on small company. So small company में इतना लंबा discussion क्यों करना? छोटी company छोटा discussion करो.
Right,
People
sir.
are very
So-
wise and chartered accountants are normally very wise people. इतना लंबा बात करके क्या फायदा? छोटी कंपनी के बारे में आपने छोटी बात करी, तो छोटी बात में छोटे में सलटा दिया. और
Yes,
अगर
sir.
कोई क्वेश्चंस अगर नहीं है तो आई थिंक द टाइम वुड बी टू थैंक
Sir,
निशा जी.
generic nature के हैं, sir. If you want, I can take it up.
It's up to you,
Because
Nisha ji. If you
someone
think
has, sir, many queries are that is it mandatory for small company to appoint company secretary?
if it's falling within the requirement, mostly it would not be because you're talking about 4 crore paid up capital. So mostly I don't think it would require CS as per the provisions of law. So mostly I don't think it would be requiring, but yeah, if I don't think, looking at the two conditions of paid up capital and turnover, I don't think a small company would be covered by the CS requirement either.
Then, sir, can a public company become a small company?
That we discussed some time back, that you can convert yourself into a private company.
Yes. So what happens if a small company exceeds the prescribed limit of this paid up share capital or the turnover?
So that, like I mentioned, turnover, if you exceed, then from the next year you will be disentitled to benefit of a small company. अब इसमें ये question आता है कि supposing let's say 14-15 your limit of turnover was crossed, 40 crores became let's say 44 crores. From 15-16 you're not a small company anymore. Now therefore the exception from DMAT is not applicable anymore. So what do I do now? Therefore say timeline was given a time, I cannot say the same timeline is applicable to go for dematting of the shares. New share capital will
yes, sir. Yes, sir. Continue, sir. Yes, sir.
So new share capital will only be in demat format. Transfers will only be in demat format. So once the new financial year comes, 15-16 comes, you must make arrangements for demat.
Right. So next query is regarding the key compliance requirement for these small companies.
What would that mean? I don't know.
The
Mane,
key compliance requirements for small companies, sir. What
so
are the
all,
key compliance?
all compliances other than those which are exempted are all applicable. अब क्वेश्चन है कि what are the key compliances? अगर आप कंपनी हैं तो पहली बात तो if you're doing any borrowings you need to file charges. Secured borrowings you need to file charges. Number 2, you need to make sure that you're not accepting any deposits. Number 3, you must be doing at least 2 board meetings in a year. You must be preparing accounts annually. You must be calling an AGM. You must be getting accounts audited. You must be, I think, if you're doing any related party transactions, you must be adhering to Section 188. You are not giving loans to directors because that would be hit by Section 185. You're not making investments in other companies exceeding the limits of 186. So if somebody asks me what are the key requirements for small companies, I would say starting from if you're borrowing, then charges, public deposits, issue of capital, Section 4262 is very important. Section 42, private placement has to be in accordance with requirements of private placements. And 42 and 62 both are connected. 62 applies to rights issues and 42 applies for private placements. And then I would say section 188, 185, 186. And then of course accounts and audit. I think these are the key requirements applicable to small companies.
Sir, rest of the queries seems to be a little bit very generic in
ठीक है,
nature. So
no problem,
it is
Nisha. I think we had a very intelligent bunch of questions. So queries asked very nice and intelligent questions. I must thank the participants for asking such brain teaser questions. They were really brain teasers and they were very pertinent. For example, कि प्राइवेट स्मॉल कंपनी में कंप्लायंस का मैं तो फायदा क्या है मेरे को, बहुत सुंदर क्वेश्चन था. So it's been a real pleasure, Nisha ji, and Dr. Mitra, who is probably in the flight already now, he's not been able to be seen here, but Dr. Mitra ko in absence, I must thank you once again for giving this opportunity.
So one question from my side, sir.
निशा जी, आप भी क्वेश्चन पूछेंगे? अच्छा, बोलिए.
जी सर.
बताइए.
सर, आपने एसएमईज के बारे में बात करी थी, प्लस आपने स्मॉल कंपनीज के बारे में भी बात किया था. तो बेसिकली सर, आपने उसमें बता रखा कि बोथ हैव अ काइंड ऑफ अ रिलैक्सेशन, दोनों में डिफरेंस है सर्टेन सॉर्ट ऑफ. तो सर, ये जानना है कि विच इज मोर बेनिफिशियल. सपोज इफ आई वांट टू गो फर्दर इन द फ्यूचर टू ओपन माय कंपनी, तो विच कंपनी आई शुड गो फॉर, वेदर फॉर स्मॉल कंपनीज और फॉर दिस एसएमईज?
No, इसमें the definitions are different, the purpose is different. Small companies for Companies Act relaxations. SMEs are basically for benefits of, let's say, bank borrowing. You can borrow money from a bank on an unsecured basis. The bank will have the benefit of CGT MSE. The bank will have a guarantee from CGT MSE. You can avail the lending will be priority sector lending. Therefore, the banks will be able to avail a priority sector lending benefit. So benefits for SMEs are basically coming from lending purposes. There are some subsidies available to SMEs. So the privileges for SMEs are coming as a part of industrial policy. I don't have a choice, Nisha ji, of which company will I go for. I will go for, let's say, if I don't need capital of 4 crores and my turnover is within 40 crores, I'll go for a small company as per Companies Act. In which case, I will also qualify for the benefit of small company as per SME. But assuming my capital increases, my turnover increases, let's say 40 से बढ़ के 50 हो गया, I will cease to be a small company, but I can still be a small company as per the industrial policy definition. क्योंकि वहाँ turnover limits are substantially higher than those under the Companies Act.
Yes,
so I'm not choosing one over the other. Depending on how my business grows, I may not qualify as small company anymore, but I may still be SME as per industrial policy definition.
So, sir, does this CSR provisions are also applicable to small companies? Because every company word is used in section 135.
So, CSR के लिए 3 condition है. Number 1, net worth. Number 2, turnover. Number 3, paid up capital. Net worth mostly will not be, I mean, because we're talking about a 4 crore paid up capital, net worth condition will not be hit. Turnover will surely not be hit. Profit of 5 crores over the last 3 years on an average may be there, but I don't think with 40 crore turnover, can a company be making a profit of 5 crores? Possibly yes, if you're in a very high margin business, probably yes, but mostly the company would not be having a net profit of 5 crores and above. If the company has that kind of a profit, then it will still be required to comply with CSR. So CSR, there's no exemption really if the company is otherwise meeting one of the 3 conditions, namely profit, turnover, or net worth. In this case, quite likely profit.
Yes, sir. Thank you, sir. With this, sir, as we are coming close of this enlightening webinar on issues related to small companies, it is my privilege to extend a heartfelt vote of thanks to all those who have made this event a success. First and the foremost, I would like to express my sincere gratitude to our respected chairman, sir, for delivering a thought-provoking keynote address. His valuable insight and visionary words have truly set the stage for meaningful discussion. And special thanks to you, sir, for leading the session with such expertise and clarity. Your knowledge and practical perspectives have provided us with actionable ideas and that solutions to tackle the challenges which are being faced by the small companies in general. And I would like to thank all the participants for joining us today, and your enthusiasm as well as engagement has actually enriched this webinar, and your questions and interactions have made it collaborative learning experience. And also, sir, there are many hands who are working tirelessly to make this event a success. My heartful appreciation goes to all the CLCGC team, the technical supporting staff, to make this webinar into a smooth execution of this webinar. So thank you all once again. And I look forward to see you at a future event. Thank you, sir, for being with us.
Thanks a
Stay
lot,
safe and
Nisha
have
ji.
a wonderful day,
Thanks a
sir.
lot. Thanks a lot. Bye-bye.
you, sir.
Thanks, everyone.